A practical application, innovative electrical services. Having redesigned the revenue side, Karel can now turn his attention to the cost side of the business model canvas, all the while keeping the business's value proposition front and center. The cost side of the business model canvas consists of key activities, key resources, key partners, and the cost structure. Karel must now use his imagination to craft a vision of what innovative electrical services must become, as though there are no limitations in terms of money, time, and resources. First, Karel crafts a vision of what the end in mind must look like, and only thereafter map out a plan of action of how he will get to the end destination. Key activities. Step 1. Karel must align the key activities of the business with his newly crafted value proposition by mapping out the business's value chain, the chain of events to produce its products. In very simple terms, the value chain consists of the following. Components and consumables must be procured from manufacturers. IES then receives the consignment of goods in inventory. IES's inventory team assembles product packages ready for sale to customers. The installation team are then notified of a sale, after which preparations are made to install a system at the customer's premises. After the successful installation of the system, the maintenance team are notified and prepares to complete a pre-planned maintenance program over several years. Step 2. Karel understands that certain core processes must run in sequence, whereas other processes must run concurrently. The sequential processes include procurement, inventory management, systems installation, and system maintenance. Concurrent processes include finance, sales, marketing, and product design and development. Step 3. Each process consists of steps made up of individual tasks that must be completed by one or more employees. Here is an example of one sequential core process, namely the systems installation process. Step 4. Karel must then identify the individual tasks that must be performed, the number of employees required to complete the tasks, and the duration of each task. Only then can Karel estimate the duration of the trade cycle. Understanding the duration of the trade cycle becomes very important when Karel sets and monitors financial goals. More on this later. After mapping out all the sequential and concurrent core processes, Karel must move on to the ancillary processes. Karel follows the same method of first identifying the ancillary processes, thereafter mapping out individual tasks, then determining the number of employees required for each task, and finally assessing the duration of each task. Karel identifies the following ancillary processes for IES: technology development, human resources, training and development, and infrastructure maintenance. Having identified the core and ancillary processes for IES, Karel can now consider what key resources the business will need. Karel identifies the following key resources: employees, vehicles, technical equipment, office equipment, facilities, and sources of energy. Karel can now calculate the number of employees required to complete each step in every process, because he now understands the individual tasks that must be performed and the duration of each task. The staff complement of Innovative Electrical Solutions presently consists of Karel as Managing Director and Office Manager, 2 recently qualified junior electricians, 2 teams of 4 technicians, and 1 general worker. Earlier, Karel decided that IES must have a management team consisting of the following management roles: an operations manager, finance manager, and a sales manager. Karel must now allocate responsibilities to individual managers and decides on the following. The operations manager will be responsible for procurement, inventory, installations, maintenance, technology, product design and development, and technical training and development. The finance manager will be responsible for financial reporting, payroll, payments, collections, and human resources. The sales manager will be responsible for marketing, sales, and sales training. The next step is to create roles. For operations, the following roles are created: inventory administrator, installations team lead, maintenance team lead, installations technician, maintenance technician, and technology specialist. For finance, the following roles are created: bookkeeper and administrator. For sales, the following roles are created: salesperson. Having developed a vision of the staff complement, Karel can then consider what other resources the business in total and each individual employee will need to complete their tasks. The type and number of vehicles, the types and number of technical equipment, office equipment, what facilities will the business need, including the warehouse and offices, and energy needs. Karel makes a major decision. He decides that for IES to become an asset of value, the business must acquire a suitable commercial property comprising of both warehouse facilities and offices to accommodate his vision of employing a total staff complement of 23 employees. Next, we consider key partners. Up to this point, Karel's focus has been internally, but now Karel must turn his attention to the topic of external partners. Karel identifies the following key partners: suppliers, manufacturers, financiers, funders, the labor union, and industry organization. Lastly, Karel needs to consider the cost structure of the business, comprising of cost of goods sold, the total cost of acquiring and selling goods, operational expenditure, the ongoing expenses of running a business, capital expenditures, the money needed to acquire, maintain, and replace physical assets. Now it's time to crunch the numbers. Karel must translate his vision for IES into numbers and uses the format of the cash flow statement and statement of financial position for this purpose. Karel starts with the organogram of employees for IES to calculate the total cost of remuneration, including directors' remuneration. Karel then includes this calculation in the cash flow statement under operational costs. Thereafter, Karel must decide what fixed and operational assets the business will need to operate and what method of funding will be used to acquire the assets. First, he makes a list of all the fixed and operational assets with their values to be included in the statement of financial position under non-current assets. To fulfill his vision for IES, the business will need a commercial property which Karel believes must be funded by way of a large deposit together with a commercial property loan over 7 years. 4 light commercial vehicles for the installation and maintenance teams, which Karel believes can be financed by way of lease agreements over 4 years. Computer equipment for each employee with information technology infrastructure, all of which can be financed by way of a lease agreement. Tools and equipment which Karel aims to acquire with cash reserves, and office furniture and furnishings, which Karel aims to acquire again with cash reserves. Next, Karel must calculate the monthly debt installments associated with the acquisition of fixed and operational assets. He makes the following calculations. Commercial property to be acquired immediately over a term of 7 years with a deposit of 600,000 Rand and at a rate of finance of 13% per annum. Commercial vehicles to be leased over 5 years at a rate of finance of 17% per annum with a 10% deposit. Computer equipment to be acquired by way of a finance lease over 3 years at a rate of finance of 19% per annum with no deposit. Karel then includes the monthly installments in the cash flow statement consisting of lease and rental installments under operational expenses, and capital repayments and interest charges under financing activities. Estimated capital leaving the business to acquire assets are included under investing activities. Thereafter, Karel again turns to the statement of financial position to estimate the total outstanding debt on all assets. He subtracts from this figure the total debt obligations that must be settled in the current financial year and include this figure under current liabilities. The remainder of the outstanding debt must be included under non-current liabilities. Also included under non-current liabilities is an existing shareholder loan. But Karel understands that the cost of ownership related to fixed and operational assets also comprise other expenses which must be included under operational expenses in the cash flow statement. Maintenance costs, repair costs, and insurance. For fixed assets like a commercial property include rates and taxes together with costs associated with utilities. In addition, include overheads under operational expenses in the cash flow statement, including telephone costs, security services, and marketing expenses. It's worth remembering at this stage that operational expenses do not relate to cost of sales. The cost of sales relates directly to expenses incurred to generate sales revenue. At this junction, Karel knows what the business's operational expenses amount to. Now Karel must estimate the cost of sales and include this under operational activities in the cash flow statement, including stock purchases, installation costs, maintenance costs, and sales incentives. Next, Karel once again turns his attention to the statement of financial position and more specifically to current assets and liabilities. To what extent will sales revenue collection be subject to trading terms? In other words, will customers demand trading terms where IES only receive payment 30, 60 or 90 days after the conclusion of the sale? If so, Karel must estimate the value of outstanding debtors and include this figure under current assets in the statement of financial position. Similarly, to what extent will procurement benefit from trading terms? In other words, will IES's suppliers provide IES with supplier credit, where the business only needs to make payment for consignments of stock 30, 60 or 90 days after placing an order? If so, Karel must estimate the value of outstanding creditors and include this figure under current liabilities in the statement of financial position. Another consideration is, will IES use short-term debt to fund trading activities? Trading activities may be funded by way of an overdraft facility or some type of trade finance solution. Include a provision for all these items either under current assets or current liabilities. By completing this task, Karel gets a picture of the cost structure of IES. Cost of goods sold by referring to the cash flow statement under operational activities. Operational expenses by referring to the cash flow statement under operational expenditure. And capital expenditure by referring to the statement of financial position. Karel has now completed the cost side of the business model canvas and is eager to start the process of transforming the business into an asset of value. However, before Karel can continue, he must decide on an exit strategy.